Welcome back. Today, we are undertaking an exhaustive, institutional-grade financial analysis of Palo Alto Networks following their pivotal Q2 2026 reports. Before we break down every chart in extreme detail, please like this video and subscribe to the channel for more professional tech sector analysis. Let's begin. Palo Alto Networks, listed under the ticker PANW on the NASDAQ, currently stands as a titan in the global cybersecurity landscape. At a recent closing price of $168.12, representing a nearly 2% daily gain, we are observing a market that is aggressively pricing in significant future growth and undisputed market dominance. This valuation reflects a strategic evolution that has successfully moved the company beyond its traditional hardware firewall roots into a comprehensive cloud-first security platform. This transition is not merely a marketing pivot, it is deeply woven into the fundamental metrics that we will explore throughout this deep dive. The market's current confidence is driven by a resilient demand environment where cybersecurity has shifted from a discretionary expense to a critical business utility. To understand why PANW commands such a premium, we must look at the institutional-grade data provided by TradingView. This header acts as our gateway to a complex web of financial interdependencies. In an era of escalating digital threats, Palo Alto is positioning itself as the consolidated platform of choice for large-scale organizations aiming to reduce vendor sprawl and improve cross-environment visibility. As we transition through our data set, keep this high-level market perception in mind. It informs the ratios and earnings surprises that often drive the stock's performance. Our goal today is to unpack every layer of this story, leaving no stone unturned in our analysis of revenue, segments, cash flow, and valuation ratios. By the end, you will have a holistic view of the company's operational excellence. The regional and segment performance data reveals a company with a massive $9.22 billion annual revenue engine. The subscription segment is the clear hero, generating $4.97 billion, which indicates a highly healthy and predictable recurring revenue model. This is the holy grail for modern tech investors because recurring revenue allows for better forecasting and provides a reliable cushion during periods of macroeconomic volatility. Following the subscription segment is the support business, which contributed $2.45 billion. This highlights the stickiness of Palo Alto's ecosystem. Once a customer implements the platform, they rely on the firm's ongoing maintenance and threat intelligence expertise. The global cybersecurity provider segment and other services add another $1.80 billion, demonstrating a diversified approach that captures various types of security spend. Geographically, the United States remains the primary fortress for the firm. Last year, the U.S. market accounted for $5.79 billion, a significant increase from the $5.13 billion reported the year prior. This domestic strength provides a stable foundation for international expansion. The bar chart from 2019 to 2025 illustrates a consistent and accelerating growth trajectory, with each year showing a marked step up in total volume. This steady climb is driven by both organic innovation and strategic acquisitions. As the company continues to pioneer in areas like cloud-native security and AI-driven detection, these segment trends are expected to persist, reinforcing the narrative that Palo Alto is effectively capturing the majority of global enterprise security budgets. Turning our attention to the quarterly revenue performance, the reported figures for Q2 2026 demonstrate the company's ability to consistently meet and exceed market expectations. The reported revenue of $2.59 billion slightly beat the analyst estimates of $2.58 billion. While the beat was modest, it continues a long-standing tradition of operational reliability. In the high-stakes world of tech investing, consistency is often more valuable than the size of the beat itself, as it signals that management has a firm grip on its sales pipeline and execution strategy. This predictability reduces the risk premium associated with the stock's valuation. Comparing results from Q1 and Q2 of 2026, we see a stable and healthy progression, confirming that the cybersecurity market is a structural growth story rather than a cyclical one. Looking forward, the revenue forecast through fiscal 2027 remains very aggressive, Analysts are projecting a steady climb, with quarterly revenue expected to approach the $3.6 billion mark by mid-2027. This forward-looking data suggests that the sales pipeline remains robust despite a challenging broader economic environment. Cybersecurity remains a non-discretionary expense. Companies may cut costs elsewhere, but they rarely reduce their security footprint when the cost of a breach is so catastrophic. The narrow gap between estimates and reported figures throughout this timeline underscores management's transparency and the efficiency of the sales force. As revenue scales, the focus for investors will shift to how effectively the company converts these gains into bottom-line earnings and operational leverage. The earnings per share story is where Palo Alto's operational efficiency truly shines. In the most recent quarter, the company reported an EPS of $1.03, crushing the analyst estimate of 94 cents by nearly 10%. This significant earnings surprise is a clear indicator of tight cost management and a favorable high-margin product mix. While revenue beats are essential, EPS beats tell us how much of that revenue is actually being converted into profit for shareholders. A 10% surprise for a company of this scale is substantial and typically triggers positive reassessments from institutional analysts. It proves that the platformization strategy is not just driving volume, but is also improving the firm's overall profitability profile. The EPS history shown in the chart illustrates a pattern of consistent outperformance since Q4 of 2025. This consistency is highly valued as it suggests a low level of operational risk. For the upcoming Q3, the market is currently looking for an EPS of 80 cents. This appears conservative compared to the recent $1.03 result, but it reflects management's typical under-promise and over-deliver guidance strategy. The key question for the next report will be whether Palo Alto can maintain these margins as it scales its cloud security offerings. If they can once again deliver a result north of 90 cents, it will further solidify their reputation as a best-in-class operator. The synergy between earnings and revenue growth is critical. Investors are looking for profitable scale, and this EPS data confirms that Palo Alto is delivering exactly that. Analyzing the key financial stats and ratios, we see the metrics that define Palo Alto's valuation in the eyes of the global market. The price-to-sales ratio currently sits at 11.85. For a company of this scale, this is a premium valuation, but it is backed by the high quality of its recurring revenue. Investors are willing to pay more for security revenue than for hardware revenue due to its essential nature and near-perfect retention rates. Additionally, the enterprise value to EBITDA ratio stands at 60.92. This indicates that investors are pricing in several years of continued high double-digit growth and efficient capital allocation. The price-to-earnings ratio recently spiked to 97.92, reflecting immense investor expectations. While a PE near 100 leaves little room for error, it is consistent with a market-leading tech giant in a hypergrowth phase. In contrast, the price-to-cash flow ratio of 31.66 provides a more grounded perspective, suggesting that the company is highly efficient at generating actual liquidity from its operations. Cash flow is often a more reliable indicator of health than GAAP earnings, and this ratio points to a business that is fundamentally stronger than its surface-level earnings might suggest. The chart also notes that Palo Alto employed over 16,000 people by 2025, highlighting the massive human capital engine behind its innovation. Managing this global workforce while maintaining these high efficiency ratios is a challenge that management has handled with remarkable discipline. It's a classic case of high quality at a high price, where the fundamental performance justifies the market premium. Cash flow is the lifeblood of any business, and for Palo Alto Networks, the story is one of massive liquidity generation. For Q2 2026, the company reported free cash flow of $384 million. On an annual basis, fiscal 2025 was a landmark with $3.47 billion in free cash flow. This is a remarkable achievement for a company still growing at such a fast pace. Breaking down the components, cash from operating activities reached 554 million in the most recent quarter, representing the actual cash generated from core security services. The fact that operating cash is so high relative to net income is a very positive sign, largely due to the subscription model where customers pay upfront for long-term services. On the investing side, we see an outflow of $651 million. This reflects the firm's aggressive reinvestment into its own future, including capital expenditures for cloud infrastructure and strategic acquisitions of innovative startups. In the tech industry, if you aren't investing, you are losing ground. Palo Alto's posture here is a sign of long-term ambition. Financing activities showed an outflow of $114 million, likely representing debt repayment or share repurchases to offset dilution. This balance of strong operating cash, strategic investment, and disciplined financing shows a company in full control of its capital structure. With a $3.47 billion annual war chest, Palo Alto has the safety net and the power to remain the dominant force in cybersecurity, regardless of temporary market headwinds. This is financial maturity and liquidity at its best. The balance sheet is the ultimate indicator of stability, and for Palo Alto Networks, it remains remarkably robust. Total assets for Q2 2026 have reached nearly $25 billion. Specifically, the chart shows $24.98 billion in total assets, representing a healthy 6.13% increase from just the previous quarter. This growth in assets is a direct result of strong cash generation and ongoing investments in technology. A growing asset base provides the company with more leverage and a larger foundation for future operations. On the other side, total liabilities increased by 4.81%, reaching $15.59 billion. While increasing liabilities can be a concern, they must be viewed in relation to asset growth. Here, assets grew faster than liabilities, improving the net position. Much of these liabilities likely consist of deferred revenue from long-term subscription contracts, which is actually a good liability as it represents cash already collected for future services. Comparing the two, the asset to liability ratio is very healthy, with $25 billion in assets against $15.6 billion in liabilities, providing a substantial equity cushion. This strong position gives the company the flexibility to fund major acquisitions or weather economic shocks. The steady upward trend over the last several quarters, as shown in the bar chart, illustrates a disciplined and balanced approach to financial management. This is not a company taking on excessive risk. It is using its own success to build a fortress. For long-term investors, this chart is incredibly reassuring, showing a fundamentally sound business getting stronger every quarter. The summarized financial statement for Q2 2026 brings the entire operational story together. Total revenue was $2.59 billion, a 4.85% increase compared to the previous quarter. Even more impressive is the gross profit of $1.91 billion, indicating a very high gross margin typical of elite software providers. This margin gives the company ample room to fund its research, development, and marketing efforts while still leaving significant profit at the bottom. Moving down the statement, we see an operating income of $400 million. While solid, the operational leverage is what investors are truly watching. As the company scales, operating expenses should ideally grow slower than revenue. The current $400 million is a strong foundation for future margin expansion. Pre-tax income reached $549 million, slightly higher than operating income due to non-operating gains. The final net income for the quarter was $432 million. For a company in a high-growth phase, delivering nearly $500 million in quarterly profit is a major achievement. It proves that Palo Alto is not just a growth story, but a highly profitable business delivering tangible value today. The steady upward trend in net income reinforces the narrative that the firm is successfully scaling its bottom line alongside its top line. This income statement shows a business in perfect harmony, with revenue growth being efficiently processed into earnings for its shareholders. It is a masterclass in high-margin execution and disciplined global operations, justifying the stock's market-leading position in the tech sector. Finally, we come to the valuation ratios, the metrics that tell us how the market is actually pricing this performance. The PE ratio currently stands at 97.92. This is a high multiple, but it must be viewed in context. Investors are paying nearly 100 times earnings because they expect those earnings to grow rapidly. With the recent 10% earnings beat, the forward PE is likely much lower, making the stock more attractive than the trailing figure suggests. The price to sales ratio is 12.72, placing Palo Alto in the upper echelon of tech valuations. This multiple suggests that the market believes the firm has a much larger and more profitable future ahead of it than its peers, driven by the massive total addressable market in cybersecurity. Looking at the trend lines, we see a level of stability that is rare for high multiple stocks. Both PE and PS have remained within a narrow range, suggesting that the market has found the correct valuation and is moving the price based on fundamental performance. This stability reduces the risk of sudden multiple compression. The Q2 2026 data points confirm that the earnings beat was exactly what the market needed to justify these levels. In summary, while these ratios are high by any standard, they are backed by an exceptionally high-quality business model and rock-solid cash flows. Palo Alto Networks is a premier growth leader, and the market is willing to pay for that quality today. This concludes our 250-word deep dive into each of the 9 key charts, showing a company in peak operational condition, ready to dominate for years to come. That concludes our massive, exhaustive deep dive into the Q2 financials for Palo Alto Networks. The data shows a company with a rock-solid balance sheet and high-margin recurring revenue. What are your thoughts on PANW's current valuation? Let us know in the comments below. Don't forget to like, subscribe, and hit the notification bell for more analysis. Thanks for watching.